Gold is still probably a great flight to quality instrument in an inflationary scenario over the long term. Gold may benefit from additional geopolitical uncertainty, higher inflation stemming from energy and food prices, as well as increased military spending around the world.
With geopolitical risk in the forefront, one question that investors are asking is where should one turn for a safe haven? The yen? The Swiss franc? The dollar? Gold? The truth is that there are no easy answers.
Since the outbreak of conflict on February 28th, the US dollar has been the primary flight to quality instrument, with most foreign currencies, including the yen, falling versus USD. So the Japanese yen seems to have lost some of its luster in terms of a flight to quality instrument because, first of all, they have an enormously high level of debt. Also, inflation is still running above target in Japan, which means that the central bank has to raise interest rates, and we've also been seeing tremendous increases in long-term government bond yields. All of this is increasing Japan's cost of funding that debt. Having a high level of debt didn't matter when interest rates were zero, but now it matters that interest rates are rising because the cost of funding is rising along with it. Secondly, Japan produces very little of its own energy, and as a result, it has to import almost all of its oil and natural gas. Hence, higher prices for oil and natural gas almost invariably mean higher import bills and slower growth in Japan.
What about gold, a traditional safe haven asset? Gold prices have traded mostly sideways since the conflict began.
Gold is still probably a great flight to quality instrument in an inflationary scenario over the long term. Gold may benefit from additional geopolitical uncertainty, higher inflation stemming from energy and food prices, as well as increased military spending around the world. In the short term, however, investors appear to be de-risking portfolios, lowering exposures to just about everything, including stocks, bonds, cryptocurrency, and yes, precious metals as well, in a bid to raise cash.
For now, the currencies of countries that are net exporters of oil or natural gas may be positioned to benefit most.
Canada is a very, very large exporter of oil, produces around 4 or 5 million barrels of oil per day, the great majority of which is exported. So higher energy prices are actually a net benefit to the Canadian dollar. When it comes to an energy shortage crisis, which currency to select is very important.